Dollar cost averaging, lump sum investing each perform well, but in different types of markets. So this is where we get into the meat of the presentation, folks. Hey everybody, welcome back to Whiteboard Finance. My name is Marco, and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about a long debate. It's been going on for as long as I can remember investing, and that is dollar cost averaging versus lump sum investing. So if you don't know what these two things mean, let's get right into the presentation. So what is lump sum and dollar cost averaging? So lump sum investing is when you invest all of your available money at once. So let's say you have $12,000. You can either take that and distribute it over time, or you can invest it all at once. If you do invest it over time in certain increments, let's just say you do $1,000 every month for 12 months, that is called dollar cost averaging. This is when you invest all of your available money over time in equal sized investments. Again, lump sum all at once, dollar cost averaging, you take that same amount and you divide it by a certain amount of time periods. So the pros of dollar cost averaging is that it reduces emotional decision making. So you're investing in a fixed amount regularly. So dollar cost averaging invests any need to make emotional decisions and also no fear of missing out, no FOMO. This also mitigates the impact of volatility because you're buying when it's high, you're buying when it's in the middle, you're buying when it's low, and you continue to buy with the mentality that most investments are going to go up and to the right over time, meaning they're gaining value. So what this does is it encourages disciplined investing, it simplifies your investing, and anyone can do it, and it doesn't require a lot of money. So you're basically taking any money that you may have and you're just investing the same amount over the same time periods over a very long time. However, there are some cons to dollar cost averaging. So you can potentially miss out on opportunities. So in a consistently rising market, dollar cost average may result in a higher average cost per share compared to lump sum investing, which we'll break all this down later in the video. But the investor would have benefited from early exposure to that asset growth. So if you lump sum at the bottom, let's say March 2020, for example, instead of dollar cost averaging after March 2020, you would have realized a lot more gain because you would have put all your eggs in one basket at one time period. Also, you have limited flexibility. So dollar cost averaging is more of a rigid investment approach that doesn't account for market trends. So investors may not be able to take advantage of short-term opportunities, okay? So what I would recommend in this situation is if you see a trend or if you see something that you're very confident about, maybe you can split up your investments between dollar cost averaging and lump summing into a certain opportunity, for example. Maybe like airlines during the lockdowns 3 years ago, if that makes sense. So number 3 is cost inefficiencies. So it's not ideal for all asset types. So depending on the investment platform and the asset type, there may be fees associated with transactions. In 2023, we're not seeing that much as it used to be back in the day where you have to pay per trade, for example. But if you are still paying to either place trades or option trades, or depending on your investment style, there may be cost inefficiencies to this. And then also, as I mentioned earlier, this is a double-edged sword in my opinion. It assumes that you're investing for a long period of time. So typically investments, if you look at least, the stock market in general, it's averaged around, there's debates between this, but it's averaged around basically 9 to 11% per year over a very long period of time, essentially since its inception. But this assumes that you're investing for a very long period of time. Dollar cost averaging isn't going to benefit you if you're doing this for a year or so, for example. So let's look at the pros of lump sum investing. So again, this is when you just take, say you come into a windfall, for example, heaven forbid someone passes away, or you get a lawsuit, or you win the lottery, or you get a bonus at work and you get this big chunk of cash. Again, this is just assuming that you're lumping it into one sum all at once. So the benefits are you have more time in the market. So there's a phrase that says time in the market is better than timing the market. So that would be you're putting in all your money at year 0 and you're expecting it to grow over time, okay? So by investing the entire lump sum at once, your money has more time to grow due to compound interest, potentially leading to higher returns over time. Number 2 is simplicity. So lump sum investing involves a one-time decision and transaction, making it a relatively simple approach compared to more frequent investment strategies, for example, like dollar cost averaging. You have the potential for higher returns. Historically, lump sum investing has outperformed dollar cost averaging, which we'll get into later in this presentation. And then you have lower transaction costs. So again, if you are paying these fees and all this stuff, which most people aren't in 2023, some people still are. Number 4, you will be paying lower transaction costs. So what are some of the cons of lump sum investing? So you have market timing risk. So say, for example, you lump sum all your money in 2006, right before the great financial crisis, or you lump sum all of your money into Japan's Nikkei in 1991, right? Take all your money, plop it in, and then the Nikkei was flat for literally 30 years, 31 years or so. That's assuming you didn't invest, equal amounts over time like dollar cost averaging. Or let's say you plopped it all into, right before COVID, right before March of 2020, you became whole, just a few months later because they printed trillions of dollars, literally. But my point is say you don't have that fortitude and you plop it in, right before a big, recession or crisis, and then you just sell. So you're buying high and selling low, the exact opposite of what you should be doing as an investor. So, there could be market timing risk with that. It could be emotionally taxing. Say you don't have that fortitude to stay in the market for many, many years. If you're not investing small amounts frequently, dollar cost averaging, and you do decide to take that big windfall and invest it all at once, it could be emotionally taxing seeing that drop 20, 30, 40, 50%. Okay, that was a reality in March of 2020. That was a reality in 2007, 2008. Potentially lack of diversification. So depending on how you invest your lump sum, you may inadvertently concentrate your investment in a specific asset class, sector, or something that underperforms. Say you're not putting it into like a total stock market fund or a broad-based ETFs or an index fund like SPY, like the S&P 500 or NASDAQ QQQ, right? Or QQQM with lower fees. You could be spooked. And then also reduced investment discipline. So with the lump sum investment, you may miss out on the discipline and systematic approach that dollar cost averaging creates. So we're going to get into choosing your investment strategy, dollar cost averaging versus lump sum. So we're going to talk about what that is, and then we're going to get into what has actually performed better. But before that, let's get into today's sponsor, which is moomoo. Today's video is sponsored by moomoo, which is a commission-free mobile trading app available for US, Singapore, and Australian users. It is backed by Futu, a NASDAQ-listed fintech that has been in the finance industry for over a decade. Moomoo offers impressive trading tools for both beginner and advanced investors. Some of the features include advanced charting, pre- and post-market trading, international trading, research and analysis tools, and most popular of all, free Level 2 US market data. I like moomoo because it's a platform that you can start using as a beginner and grow into over the years as you become more and more experienced as an investor. We can place simple buy and sell orders, but also start using more and more of moomoo's advanced research and trading features down the road. Since this is a video about lump sum versus dollar cost average investing, I wanted to highlight a feature that moomoo offers that could be excellent for beginners, and this feature is paper trading. Their paper trading feature covers multiple investments such as stocks, ETFs, and options, which are all available on moomoo desktop, the web version, and the moomoo app. Whether your approach is aggressive, conservative, or somewhere in between, you can put your trading strategy to the test without risking any of your hard-earned savings. With moomoo's paper trading tool, you can trade with real-time quotes and data in a realistic simulated environment. Access pro-level tools and start using new charts and indicators to help shape your strategy. Follow top-performing traders in our paper trading community to learn from their strategies. Whether you are a new or experienced investor watching this video, moomoo is a platform that you can grow into over time. And on top of that, they're currently offering up to 17 free stocks to those who open an account and make a deposit for U.S. users. Australian users can get up to 110 Australian dollars worth of cash coupons to be used in trading with terms and conditions. Both are limited time special available when signing up via my link, so be sure to use the link in the description below to sign up, and for more information about the promotion, terms and conditions apply. Okay, thank you for sitting through that. It helps pay for all the production costs of this channel. So dollar cost averaging reduces market timing risk. It simplifies investing and instills investment discipline. Lump sum investing saves time, has the potential for higher returns, but brings on higher risk. So what now? So dollar cost averaging and lump sum investing each perform well, but in different types of markets. So this is where we get into the meat of the presentation, folks. So dollar cost averaging performs better because it invests fixed amounts at regular intervals, okay? This dollar cost averaging allows you to accumulate shares at lower prices as the market falls, and it helps you avoid emotional investing. So this is an example from Hartford Funds. This was released last May, May of 2022. So you can see the dollar cost averaging investor is in this square over here, if you will, and then the lump sum investor is in this square over here. So if this person invested 25 grand each quarter and these share prices are changing or falling, they're going to end up with an average share price of $191 with 526 shares purchased. Their total cash outlay was $100,000. Their ending value was $94,632 for a $5,300 loss with a total return of negative 5.37. Okay, this is in a bear market, I guess, if you will. And then if you look at the lump sum investor, they just put in 100 grand in the first quarter at $200 a share, and they acquire 500 shares. You can see if the market drops 10%, they're dropping 10% as opposed to getting in a little bit, each quarter. However, if you look at the same scenario as the market increases in value, which we've seen over the past 14 years or so, you can see that lump sum investing outperforms in rising markets because of immediate exposure. So if we look at the same scenario, this person is putting in $25,000 a quarter. This person is putting in $100,000 all at once. You can see that this person is acquiring shares as they rise, which leads to less shares purchased at a higher price for a total return of 4.89%. And you can pause the screen. I don't want to go through every single cell here. Otherwise, the video will be very long. Or you can see the person plopping in $100,000 in a rising market. They're buying 556 shares at $180 a share for a total of 556 shares purchased at an average price of $180 a share for a 10.09% return overall, absolutely crushing the dollar cost average investor. So take a look at this one. Which is better overall? So if you look at dollar cost averaging performance over 24 months versus lump sum investment of the S&P 500, this is from dollarsandData.com. This is my buddy Nick Majuli. I had him on the podcast a few months back. Basically, lump sum investing has tended to perform better overall than dollar cost averaging. This is because markets have generally gone up, and you can see here this is basically since 1997 to 2022. You can see that this is 0% right here. You can see dollar cost average outperformance. So it's actually underperforming most of the time. It's only outperformed in the early to mid 2000s. During the great financial crisis right here, and then ever since then, it has absolutely underperformed lump sum investing. However, past performance doesn't indicate future performance. So if you look at the standard deviation, this means if you look at the standard deviation, just picture a baseline, how much above or below, or what are the highest spikes and the lowest spikes, just in a nutshell, I guess. Lump sum is riskier than dollar cost averaging. So the standard deviation of returns is higher for lump sum. This is because lump sum invests right away and gets full exposure. So if you look at the standard deviation from 1960 to 2022, you can see the blue line is lump sum investing. You can see how the standard deviations are higher. It's above 6%. And if you look at the black line, which is dollar cost averaging, the standard deviation only gets to about 4.5%. See the difference there? So the lump sum is more wild, if you will, or more volatile. The dollar cost averaging is going to get you in between basically 0 to 4.5% standard deviation, if that makes sense. So how can you position yourself? So assess your investment goals and risk tolerance. So you have to understand your ability and willingness to experience market volatility and losses. You need to understand your financial objectives and your investment timeline. You You need to stay informed about market trends. So dollar cost averaging and lump sum investing both work, but in different types of markets. And if you stay informed about trends and conditions, this may better position you to understand, hey, do I want a dollar cost average or do I want a lump sum? And then finally, stay disciplined in your investment approach. So regardless of what you pick, if you don't stay disciplined and if you're susceptible to FOMO, fear of missing out, you're listening to locker room stock tips, you're listening to stock market, Jim Cramer, stock market YouTubers that just put out content to put out content, of course you're going to be all over the place, you guys. So let's get into my thoughts as always. So I personally dollar cost average. I've been doing this for years, okay, for about 14 years or so. I've been investing since I was 18. I'm 35. I've been investing for 17 years, 17 and a half years, since I was a senior in college, senior in high school, freshman in college. But basically, I've been dollar cost averaging for a long time because for me, I've been studying financial markets for a very, very, very long time. I followed the Nikkei in the early 90s. I followed countries with hyperinflation. I followed the United States stock market, the FTSE. My point is, in a nutshell, what I'm trying to describe here is that I've seen so many people get crushed, and I'm also a product of the great financial crisis. So I was actually getting my finance degree when people were getting crushed 30, 40, 50% during the mid-2000s, right? So that's always going to be in the back of my head. So when I think of like lump sum, I think of like, oh crap, what if I lump sum right before a huge recession, right? And there goes, 20, 30, 40% of my investment just like that. And you're getting in at the top and hoping that it doesn't take years or decades to get back to where you invested. So I prefer dollar cost averaging. Mathematically, as you can see from this presentation, it doesn't make sense. From a numbers standpoint, it doesn't make sense for the most part. But from a peace of mind standpoint for me and a discipline standpoint for me, dollar cost averaging makes sense. Every week I buy stocks. Every week I buy Bitcoin. I've been doing this forever, okay? So my point is that if you can stomach the lump sum volatility, which we saw in the previous slide, the standard deviation is higher for lump sum, then lump sum is the way to go. If you're someone who's going to buy at the peak, sell at the bottom, and you have no idea why you just even bought what you just bought, that's probably not for you. If you're someone who doesn't want to dedicate their entire life reading 10Ks, financial reports, burning the midnight oil, doing all this research on top of, having a family, having a life, having hobbies, living outside of the financial markets, unless studying financial markets is your hobby, that's fine, then dollar cost averaging is probably going to be the way to go for most people. It's kind of like Dave Ramsey's snowball versus just paying off the highest interest rate debt. So he's talking about paying off your lowest debts in order. That way you kind of snowball and you start to get that momentum or that confidence. Oh, I paid off this small debt. I paid off this medium debt. I paid off this large debt. However, the math, obviously for anyone that has a mathematical brain knows that you should pay off your highest interest rate debt first. It's kind of like lump sum versus dollar cost average. For me, dollar cost average is kind of like the snowball. You're just kind of investing over a long period of time, little bit, regular increments, regular time periods. Paying off the highest interest rate debt would be like lump sum investing. You know that it's going to be more volatile, but at the end of the day, you're making the correct mathematical decision. So there's no wrong way about this. If you look at the last slide, we talked about just sticking with it. So if you stick with it for a long period of time, you should be good. But for me, dollar cost averaging is what I prefer. Hopefully that you got value out of this video. Please share it. Please like it. Please hit the bell notification to get more content like this. I do this for free. I've been doing this for free for 5.5 years. Also, check out WhiteBoard Finance University. We will be launching that within the next month or so. I have 4 professors on board. It's basically just a private community with access directly to me every week through a live stream, and then a growing library of real estate investing, ETFs, stocks, and personal finance and budgeting. We have 4 professors teaching those subjects. It's going to be worth every penny. Thank you so much, everybody, and have a prosperous day. Hey, real quick, so just to give you guys some perspective, let's just say we're in Japan in 1991. This is March 22nd. The Nikkei was at 26,600. If you fast forward all the way to right here, December 18th, 2022. So basically 30 years later, that's when you got your money back. So these are the things that I think in the back of my head, where if you didn't dollar cost average and you just lump summed, you're kind of holding the bag for literally decades. So I'm not trying to scare anyone. Just keep that in the back of your mind when lump sum investing. This is why I prefer dollar cost averaging, because I've seen this happen too many times throughout history. Same thing with the dot-com bubble. If you look at stocks like Cisco, if you bought Cisco in the 2000s, you're still not even back to where that stock was 20 years ago. So just something to think about, you guys. Not trying to scare you, but that's why I dollar cost average.